All right, folks, given what's happening in the market today, I figured what better and who better than Larry McDonald to get Larry on the horn. And he only had a limited amount of time, but we got him. And I can't disclose where in the world he is. It's probably somewhere other than where I am. But Larry, welcome, sir. Great to have you.
Thanks, John. It looks like you're very comfortable there. It looks like a beautiful afternoon, right?
It is. It is. Now, Larry, just so I don't drag it on too long, please give folks a little bit of a background because this is a guy, folks, that was unbelievable in the financial crisis or any of the subsequent crises, and he's a great follow all the time, Larry McDonald. But tell people what you do, Larry, and basically your migration from investment banker and analyst over at Lehman Brothers to what you do now.
Well, thank you, John. I'm really proud. Our book's now in 12 languages. It's a New York Times bestseller, but we just were named as one of the top 20 business books of all time by the CFA Institute. It's called The Colossal Failure of Common Sense. It's great for the young people in the audience. It basically brings you right into that front row seat of the Titanic situation with Lehman Brothers in 2008. And I'm at ConvertBond on Twitter. We run behind me. I'm really proud. We've got the largest platform facing institutional investors, right? So hedge funds, mutual funds, pension funds pay us to provide kind of real-time content during the day, like it's a live chat, live conversation. We've got contributors and relationships in 16, 17 countries now. And so that conversation, what we do is we recap that lens on that buy-side conversation. We've recapped for the financial advisors and the high net worth family offices. And so I want to give, my mission is to level the playing field, give that family office, that financial advisor a lens on a private buy-side conversation, but cutting out the sell side and it's really just talking to investors. That's what we're trying to do.
Fantastic. Well, like I say, folks, and you don't hear me say it about too many people, but this is a guy I really listen to, and you should too. So given what's going on with Signature Bank, Silicon Valley Bank Corp, obviously the horrible things that happened at Silvergate and so forth, maybe give us your take on what's happening now with these banks and what we're likely to see, not just Monday next week, maybe, Larry, but over the next several weeks and months.
Well, so when we're talking to the institutions live during the day, the last 24 hours, one thing that they're saying for sure is that the entire street misjudged the hose, I should say, between the treasury bills and the banks. In other words, when you take the front end of the yield curve and you move it from 3% to 4% to 5% in 4 months, and that's what they did since October, from 3% to 5%, right? So if you have $10 million in risk-free money market funds, that pays $510,000. And so that money is coming out of the regional banks because these regional banks are like old, kind of sleepy places, right? And they haven't had any interest rate risk, John, for 20, 30 years. So you're talking about a complacent group of people. It's about 5.3 trillion of assets across the KRE banks. So if you look at the KRE ETF, if you add up all the assets of those banks, it's about 5 trillion. And the deposit officer, the CFOs at these banks, they haven't moved up the deposit rates as fast as the Fed has. So the Fed's moving rates up at 100 miles an hour. The banks are raising their deposit rates at 5 miles an hour. And guess what happens? Money leaves the bank very fast. I've heard story after story. I have a friend up in New England, has $2 or $3 million in the bank, has never left the bank, John. Never left the bank until a week ago. He moved the whole thing to T-bills because he's getting an extra 150, 200 basis points of interest from Uncle Sam risk-free. So that's draining the banks. At the same time, the banks are holding on to these assets that for years, John, years and years and years, they never had to mark these assets to market ever, right? Because they're only 1, 2, 3 year securities. There's treasury bonds. There might be mortgage-backed securities. some commercial real estate lending securities, CMBS or something like that, and some corporates. And so, in other words, they've never marked these things to market because typically there's not a lot of interest rate risk. But what happens is, once again, when the Fed hiked interest rates so much, now a number of banks have billions of dollars of losses, and the Fed is, and I think the Treasury, the Fed behind the scenes, I think the FDIC, I think the OCC are finally forcing these guys to mark these assets to market. And so what happens is, if you have a decline in your asset value because interest rates go up, bond prices go down. So if you're holding $100 billion of treasuries and mortgage-backed securities, and so you're probably going to have potentially a billion or $500 million but $100 billion, you might be losing $1 billion, might be losing $500 million. And so those losses because the way banks are regulated, you have to basically fill that hole, and you either have to sell the assets or you have to sell stock in the secondary market, which is really bad. It's more dilutive. And so that's what's creating this kind of liquidity crisis in the regional banks.
Right. And I heard, Larry, that like some of these, like perhaps Silicon Valley Bank, might have had as much as $20 billion in stimulus checks deposited in there. That's, of course, from individual investors and so forth that just got a check from the government. They put it in the bank. They have all this money. And then, unfortunately, they bought a lot of 10-year mortgage rates and things like that were yielding at that time 1.5%, 2%. And now those things have gone like this. And when there's a run on your bank, you've got to give money. You can't give 10-year mortgage paper to the customer. So it just, it's a spiral. Once it starts, it's like really difficult. Do you think we're going to see a lot of significant failures because of this?
Well, the first stage will be the forced marriages, similar to what I talk about in my book, the Bear Stearns countrywide stage of the crisis. The first thing they'll do is they'll force, your JP Morgans, your Bank of America, this weekend will probably be doing emergency work looking at the balance sheet of a number of banks. This is not just one. Like you said, there's been a massive contagion because all the analysts are looking at the marks and they're saying, okay, this bank is not isolated with this situation. It's probably a number of other banks. And I'm even hearing, John, this is fascinating. A number of hedge funds and institutional investors in the chat have told me that the Fed is extremely annoyed that they've hiked rates and financial conditions over the last month and a half haven't tightened that much, right? So the only way to kill inflation really is with tighter financial conditions. That's what we know over the last 60 years, 50 years, 40 years. The way to kill inflation is with like Lehman. If you really want to kill inflation, you have Lehman-like type financial conditions. That's too much, right? But they want to tighten financial conditions pretty aggressively. And behind the scenes, John, this blew me away when I heard it last night and I heard it again today. They actually want tighter financial conditions. They weren't happy. So now behind the scenes, they're forcing these banks to mark things to market to cause tightening of financial conditions. And that will really start to hit inflation at some point in the next couple of months. But they actually, are for the first time, because I have clients on the hedge fund side that have been short these banks. And John, I've got a client. This is a great story. He's tracking like 9 CFOs and 9 CEOs. He's tracking them from city to city. He's been short a number of these banks. These banks were ripping in his face in January, and he's been tracking their public statements. He's been tracking their conference calls and their SEC filings, and they haven't admitted to any of this. And there's been question after question from different analysts, and they've really just been obfuscating this problem. And now all of a sudden on Wednesday night at 5 o'clock, something happened behind the scenes. So the OCC, the FDIC, the New York Fed, somebody came in and said, stop the bullshit. Because like you said, John, if you have a 1% mortgage, say you have it's $1 million bond, right? And it's a 1% coupon. If rates go up by 4 or 5%, that 1% coupon bond is not worth $1 million anymore. It might be worth, it might be worth, $800,000. I mean, I can't do the quick math, but it could be worth 20% less because your 1% coupon goes up. The yield on new bonds is at 5% because the Fed's pushing up rates. So the existing bonds that are out there that are 1%ers, they have to go down in price to compete, and that's the mark to market problem that's out there.
Wow. So you're saying we should look for some emergency procedures this weekend, maybe even as soon as the market closes mercifully today. These banks, many of them will probably, it'll be like in your book. It'll be like in The Big Short. Many of these folks, Jamie Dimon or, any of the folks at the biggest banks probably won't sleep much this weekend because they'll have to go down and sit with the Fed. And basically the Fed will say, you're marrying this one. This one's getting gobbled up by you and so forth, because we can't have failures on Monday, Tuesday, Wednesday, next week.
Yeah, exactly, John. They know that if they don't attack this aggressively, it's going to get a lot worse because there's the classic run on the bank. And the thing about runs in the bank is sometimes good banks get taken out because that loss of insecurity and confidence. And one of the things I talked about in my book and is very powerful. You and I have talked about over the years. It's like this, when you have a crisis. I remember you and I were talking about this during the COVID situation. COVID hit and there's like a fog. So you don't know where the counterparty risk is. So if you're a bank or a lender, counterparty, there's going to be like a 30, 40-day period where you hold back and that everything freezes and lending freezes. And because people don't know, okay, is this a good bank? Is this a bad bank? I'm looking at some gems here, like Texas Capital Bank, TCBI. That bank has, listen to this, Sean, they just did an asset sale in the last a couple of months. They've got $3.2 billion in cash, right? And the bank is trading at a market cap of 2.6 billion. So in other words, it's trading below cash value. And so we're going to have some great opportunities, but in the meantime, because of that fog, the market, rallies and drifts lower. And then like we saw with Lehman, David Tepper and his team, they took, September 2008, October, November, December, over 3 months. It took them 3 months to figure out, okay, who are the winners, who are the losers, and then people start to get long. But there's that gray fog that creates the downdraft, and we're on some huge technical levels, like we're failing at the 200-day moving average. The S&P went out of the bear channel. Now we're back in the bear channel. So we probably drift a lot lower the next month, and then we figure out the winners and losers. The Fed will probably cut rates by 100 bips by year end.
Woo! Well, and folks, that's not just a guy looking for headlines. That's a guy that has called it multiple times, which is why I called him. So Larry, you're a gentleman. I'll be joining you in Miami in Wednesday next week with a bunch of your great clients, and I'm looking forward to that. I really
can't wait to see you, pal.
I appreciate your insights, man, and your friendship.
Thank you, my friend. God bless.
Thank you.
Okay.
Larry McDonald. He's the best, folks.
Want more from Market Rebellion? Don't forget to like and subscribe, and learn more about options trading at marketrebellion.com.